Risk appetite staged a strong comeback in the week on positive economic data from Europe and China. In thin holiday trading, the Dow Jones soared 3.3%, or 421 points to close above the 13,000 psychological level at 13,009.68. The dollar tumbled sharply and took out near-term support levels against European majors and the Canadian dollar, which argues that more downside is coming. The dollar index indeed tumbled to close at 80.192, well below the near-term high of 81.455 made last week. The Japanese yen continued to be the weakest currency on expectations of aggressive easing from the Bank of Japan, with euro-yen jumping over 3%, while New Zealand dollar, Australian dollar, British pound yen and Canadian dollar yen were all up over 2%. Technically, the strong rebound in stocks came a week later than we thought and was somewhat unexpected. But for now, 12,500 seems to be a strong level in the Dow, and as the index is back above the 13,000 psychological level, it's more likely that it will now head to test the recent high of 13,661. The dollar index's fall left the rebound from 78.60 to 81.45 with a corrective structure and will likely see more downside ahead. This is affirmed by the bullish outlook in euro dollar and British pound dollar, as well as the bearish outlook in dollar Swiss franc. Nonetheless, we expect the yen to remain the weakest currency and going yen short is still somewhat preferred to dollar short. Among other major currencies, the euro seemed to have an upper hand against the sterling, Canadian and Aussie, thus, we prefer to long euro-yen going into the week. U.S. trading was shortened by the Thanksgiving holiday last week, but the main focus remains on the issue of the so-called fiscal cliff, which refers to the $607 billion combination of automatic spending cuts and tax increases scheduled to take effect in January, unless a deal can be made by President Obama and Congress leaders before the deadline. The Congressional Budget Office estimated earlier this month that the fiscal cliff, if unresolved, would make the U.S. economy contract 0.5% in 2013 and push the unemployment rate back to 9.1%. Fed Chairman Ben Bernanke said last week that the Fed lacks measures to alleviate the impact of the fiscal cliff. He warned that Congress and the administration will need to protect the economy from the full brunt of the severe fiscal tightening at the beginning of next year, as the fiscal cliff would pose a substantial threat to the recovery, and a fiscal shock of that size would send the economy toppling back into recession. In the Eurozone, nothing solid happened in the ECOFIN meeting, nor the EU summit on budget. There was no agreement on the package of the 2-year extension, nor was there approval for the next tranche of bailout fund for Greece, which has been on hold since June. EU officials also failed to agree on the budget plan for 2014 to 2020. Nonetheless, the common currency was supported by optimism that there will be a definitive deal on Greece this Monday. European Economics Commissioner Rehn said that he saw no reason why we should not be able to conclude the package. Meanwhile, German Chancellor Merkel also said that there were chances to get a solution on Monday. Also supporting the euro was German IFO business sentiment. The business climate gauge rose from 100 to 101.4 versus expectation of a fall to 99.5. The current assessment gauge improved from 107.3 to 108.1 versus expectation of 106.3. The expectation gauge rose from 93.2 to 95.2 versus consensus of 93. The IFO said in a statement that companies in Germany expressed slightly greater satisfaction with their current business situation, and are far less pessimistic about future business developments. The Bank of England decided unanimously in November to leave the bank rate unchanged at 0.5% but voted 8-1 to keep the asset purchase programme unchanged at £375 billion. David Miles favoured increasing asset buying by £25 billion to £400 billion. The central bank's decision was also affected by the Treasury's decision to transfer gilt coupons earned from the asset purchase programme to the Exchequer. The Bank of England deemed that the arrangement implies a small easing in monetary conditions. The Bank of Japan ended the policy meeting with an unanimous decision to leave interest rates and asset purchases unchanged. That followed expansion of the size of the asset buying program in September and October. The asset purchase size stayed at 66 trillion yen while the credit lending facility was maintained at 25 trillion. It's likely that further stimulus will be announced in December, at the meeting 4 days after the election on December 16. Another round of sell-off was triggered as Liberal Democratic Party leader Abe, the most likely candidate to succeed Noda as the next prime minister after the December 16 election, pledged to achieve 3% economic growth and set a 2% inflation target. Analysts are perceiving the targets as implication of extremely aggressive policies that go beyond quantitative easing, but also a targeted yen weakness policy. There was even talk that US dollar-Japanese yen could go back to above the 100 level should the Liberal Democratic Party follow through on the implementation of these policies. The pause the Reserve Bank of Australia policymakers made in November has greatly lifted the chance of a rate cut in December. In the minutes released for the meeting, the central bank viewed the current policy rate at 3.25% as appropriate but signaled room for further easing. As the Reserve